Unless you've been living under a rock, then I'm sure you remember last week's trading events, one in particular, company called Greenwich Life Sciences. Now, before I get started, let me tell you that this is not the company that I was trading, but this is related. So let me tell you, GLSI is the ticker symbol. That stock, which was a penny stock at the time, went from $5 to around 180 something bucks. Okay, 2,800% move. So if this isn't the stock that I was trading, why am I even bringing it up? Well, because in the market we have something that's called a sympathy play, which means that related stocks will run based off of the stock that's related to it running. Now, I hope that makes sense to you. If not, I will try to explain further later. But not only do we have sympathy plays that go on all the time that are easy to take advantage of, there are also other plays that you can find simply by going into Robinhood and looking at the top movers. Now, this is particularly funny because I always see people in forums and on, comments on Webull talking about, oh, well, this stock is on the Robinhood top movers, so you know what's going to happen to it. Sure enough, most of the time it does. Now, don't go thinking because of this that you can just go in and pick any of those stocks and hit a home run, because that's not how it works. There is great risk involved, and oftentimes, yes, these stocks do move, but they will fall just as hard right after making a move, and it's hard to make a decision on when you should pull out, especially for some of you newer guys that are trading, guys and gals, I'm sorry. It's hard. And if you think that it's not and you enter one of these trades, human psychology will prove you wrong almost every single time, unless you have experience in trading and know what you're getting yourself into. In this video, I want to introduce you to one very simple and basic strategy that you can use to take thousands of dollars out of the market. And we're going to be starting right now. Hey, what's going on? It's Pat from Top Ticker Trades. If you're new here and you want to learn how to use stocks and options to make your portfolio go parabolic, make sure you start now by subscribing and tapping that bell so you never miss an upload. What is going on, ladies and gentlemen? Welcome back to the channel. Welcome back to another video. In this video, I plan on teaching you a very simple strategy, a basic level strategy that will allow you to make a lot of money most of the time. Now, I will say this is an options trading strategy, but it's a very basic and simple options strategy again. But nonetheless, it is risky. All options trading strategies can be pretty risky. So I will encourage you not to FOMO into these types of trades. These are trades that work well only in certain types of markets. The market that we are in right now is almost perfect for these types of trades, but that can change at any time, so keep that in mind. When this trade stops working, stop using it. So by nature, these trades are very volatile, meaning you're going to see them going up and down all day long. What you want to do ideally is try to get in early in the morning, but sometimes that's not possible because sometimes the price is already too high in the morning. But also remember that volatility is highest in the morning and then picks back up later on before market close. So knowing this, you want to wait and time this perfectly if you've got your eye on a play, and I'm going to show you how to find a play in just a second. But if you're eyeing a specific play, you wait until the price is right, and then you jump in. Now, once you jump in, your next prerogative, and this is assuming that you actually follow the ground rules that I'm about to lay out for you, but once you jump in, you're essentially waiting for the price of each individual call contract to exceed the total cost that you have invested in the entire trade. So from there, you will close one of the contracts to take the cost of the trade off the table. And now you're in a great position because you no longer have any risk that's left on the table. All right, so that was essentially a quick overview of what you can expect out of the trade and what the trade would actually look like. And now I'm going to move forward and give you some ground rules that you will want to follow and go into some of the details of why we will be following these. And then after that, I think we'll be ready to finish up with me showing you my last play and giving you a few simple guidelines on finding these types of plays. Now, if you don't know how to buy an option or you've never bought an option before, have no worries, because I'm going to be showing you how to do that as we're going through this as well. Now, I want to get right into it, ladies and gentlemen, but before I do, I would like to ask you to please consider giving this video an early thumbs up, as it greatly, and I can't stress that enough, helps to support this channel. I put a lot of time and effort into each video so that we could all make money from the market together. And if you're not part of the family yet, I want you to join my family. We're growing fast, both as a community and financially by the day. All you have to do is hit that subscribe button, and don't forget to tap that bell so you have access to videos as soon as they come out. So a lot of you watching already have some experience trading options. Some may have extensive experience, while others have no experience at all. With that being said, it seems that there's always somebody in the comments section that wants to throw a fit about these videos being too long, or about me talking too slow or too much, or one thing or another. So let me say this, I'm definitely not going to be cutting corners in this video, as I'm considering my entire audience and not just a select portion of them. So if you are one of my frequent complainers, feel free to use the YouTube player controls to fast forward through any parts that you don't want to see. So this strategy will literally work on any stock that has options trading available. I've used it in the past on momentum plays with stocks like NIO, Tesla, Facebook, and many, many more. But what I'm teaching you today will focus more on stocks that are normally not big movers and are not expected to reach the strike price that we will be buying, which is how we're going to be able to take advantage of the move. And that's because if the move is expected, then the market will have it priced in. So for this specific play that I'm telling you guys about today, I used it on a biotech stock called Veru, in which I bought the $7.50 call that expires on December 18th. And I paid roughly 10 cents per call. I bought 5 calls, so that was $50 spent. So I sold the first call at 75 bucks. So that pretty much not only covered the entire cost of the trade, it also gave me 25 bucks worth of profit, which isn't a very big deal. I mean, I don't care about 25 bucks necessarily, but like I said, that's just one call, and now I can let the other ones run free. I then sold 2 more calls. One of them I got 135 bucks for. The other call I got 165 bucks for. So as you can see, this has quickly, been adding up and given me some pretty decent profit. So that was 3 calls sold out of 5. So far, I've got 375 bucks total that I've gotten back off of just spending 50. So my profit would be 325. Now I sell another call for $100. And what had happened here, these calls ran up essentially to 180 bucks. So from 10 to 180, I could have taken $170 profit on each one had I sold at the very top. So that would have been about $900 out of 50 bucks. Now, instead, didn't sell at the very top. I mean, I don't think anybody here is good enough to always be able to predict the top and the bottom. And I'm certainly not, and I'm not going to try to pretend that I can. But I sold this call for 100 bucks as the stock was coming back down. And I thought that was pretty much going to be the end of it, because the catalyst for this stock at the time was an event. But at the same time, this was also a sympathy play. And I was expecting perhaps a run similar to GLSI, and I'm going to explain all the details surrounding all that in just a second. But anyhow, when the stock started falling back, it actually took a significant dive. So I thought the run was going to be over, and I sold that call for 100 bucks. But I went ahead and kept the call, and as you can see, that call is now worth $68. So why would I keep that call? Well, the reason I kept that last call is because when I was trading these calls, and the entire reason I bought these calls, what I told you earlier was, number one, a sympathy play, but number two, I knew that there was a catalyst, which, as I said before, was an event. Now, the event was that the company was giving some sort of presentation where I was expecting good news to be announced. Now, this is a biotech company and they can be very volatile. They are very volatile. And with these companies, what we see very often is buy the rumor and sell the news. I've seen it before a million times, and I used to only very heavily trade biotech stocks. Now, knowing what I know from trading them in the past, I knew what to expect with an event. I knew that a lot of the times, or most of the times even, you were going to see buy the rumor, sell the news. So that's kind of what I prepared for, which is why you saw me selling these calls at all sorts of different price points. You basically want to take profits along the way so that, you initially get your risk off the table, and then you're also making some type of profits going into the event, because 90% of the time, if not more, you're not gonna keep seeing run-ups afterwards. People just dump the stock and that's that, which is initially what we saw here. But, and this is a very big but, the next day, this call, it was down to about probably $10 again, or maybe even 15, 20 bucks. I don't remember exactly because I was no longer paying attention to it very heavily, but I was pretty much leaving it, on the table just in case something happened. Like the actual news from the event was so good that we saw a GLSI move. Now, while I'm not expecting that really to happen anymore, what I am expecting is another move up. Now, we do see that from the, however much it fell to, whether it was 10 or 20 bucks per call again, it's back up to 68 bucks, and the stock started moving again in the after hours, and it's almost back in the money. Or, about a buck away from in the money, which these biotech stocks can move. Now, the sentiment is very, very good surrounding this company right now, and they did have some very big news. So there's no telling what will happen, and I've still got quite a bit of time. Well, I've got a week left on this option before it expires. So this is really a crucial time for this option, because the closer it gets to expiration, the more money it loses every single day. But like I said, I'm no longer worried about, this option even going to zero, because I've already taken profits and I've already taken all the risk off. So this is pretty much like buying a lottery ticket, except this thing can explode and be worth a lot more than a lottery ticket. So to me, it's worth holding just to see what happens. Imagine this thing moving to 190 bucks or whatever, making a GLSI move essentially. And I had this call, but sold it for 68 bucks or 100 bucks or even 180 bucks. I would be steaming mad and furious, because had this thing, if this stock goes to 100 bucks or even 50 bucks, this thing will be worth an incredible amount of money that I don't want to miss out on. So, like I said, it's like a scratch off, and now I'm holding it, but it's no longer gambling because there is no risk. So here are a few other things that I want to point out. Now, if you'll look at your screen right now, you'll see that the volume on this specific option, which is a $7.5 call, is 11,275. So that means that, that was how many times this option went around, was purchased. That's insanely huge. And the open interest on it is 5,535, which means that that's how many open contracts there are on this option right now. Those are some pretty big numbers. Normally for these little penny biotech stocks, especially for a $7.5 call, the open interest would be like 0 or 5 or something, ridiculous. And the volume would be about the same. That's just how it works, because this call was essentially a worthless call, and it was expected to be worthless. Initially, this call was about a penny, which means it's worth $1, because every call is 100 or controls 100 shares of stock. So I was trying to get in at a penny, and I would have bought, 50 of these. Unfortunately, it wasn't filling. So I think the mid price was about $5 at the time, and couldn't get filled at 5. but I wanted to enter pretty quickly because I didn't want this to run up on me and me having to pay above $10, you know, per call on this. I mean, these things are risky, and you know, essentially they are a gamble at first. So using some of the information that I just showed you using my own trade, I want to provide you with a set of best practices or guidelines that you can use to not only help you find trades like this, but also to enter and exit at the right times. While I have you here, I wanted to quickly tell you about the brand new First Trade app, available for mobile or PC. The platform will give you access to powerful and easy to use tools and allows you to trade with less restrictions, zero commissions, zero fees, and you can use the first link in the description below to download a free stock today without having to deposit any money. This will greatly help out the channel and is always appreciated. And now back to your regularly scheduled programming. So let's very quickly talk about how we're going to find these trades. And while I'm sure that there are many different ways to find these types of trades, I may put a video out on this later if this one gets enough likes, hint, hint. But for today's video, I'm going to be basically focusing on just one very easy method. And we will be using the Robinhood app for this. And what we'll essentially be doing is taking a look at the top movers and then pick a stock that is making a move. And the next step would be for you to find out if this stock does allow option trading or not. Obviously, if this stock does not have options available for trading, then what you would want to do is pretty much pick another stock and make sure that it lets you trade options. So that's the first thing we're going to be doing. And we're pretty much going to be using day trading rules, or at the very least, we'll be using some of them. We'll basically be borrowing some rules from day trading to make this work for us. We will be using the Robinhood app for this, and what we'll essentially be doing is taking a look at the top movers and then pick a stock that is making a move. The next step is to make sure that this stock has options trading available. And if it doesn't have options trading available, obviously you're just going to repeat the process and find the stock that does have options trading available. So first of all, we want to make sure that the stock does have some type of news or a reason to be moving. Otherwise, there is no way for us to gauge where it may go or even when it'll stop moving and potentially reverse. Now, the next step after that is for us to analyze this catalyst, okay? That's assuming we find a catalyst. But if we don't find a catalyst, then I would say we don't take the trade. It's just too risky. But say we do find a catalyst, we're going to analyze it. So if or once we actually do find the actual catalyst, we're going to determine whether it's the right kind of catalyst. And by that, I mean whether it's a catalyst that we expect will continue to make the stock keep moving higher or not. And by that, I'm talking about making it move higher today. We're concerned about the right now. So ideally, I want to be doing this with stocks that I know and understand so that I know what to expect. And like I've told you earlier in this video, I did this several times with stocks that I do know, like NIO. And NIO being one of the stocks that I'm very familiar with, I've done this with NIO a lot as opportunities have presented themselves. And the market that we're in right now, or that we've been in, and especially with all of these SPACs that we've seen running, this has worked out like a charm. But in markets where we don't have crazy SPAC plays running up every day, and where you're relying on the top movers, you generally are going to be trading stocks that you are not familiar with. So to give yourself the absolute best chance of winning, trading a stock that is running up on pre-anticipation or a pre-anticipation run up to a catalyst may be the ideal situation. So the reason that I say that is because there's a lot of uncertainty and also a lot of hope. At the same time, there are also high expectations out of these stocks that are trading on pre-anticipatory runs. This is especially true if you have other stocks in that sector experiencing similar catalysts that are moving, or maybe a catalyst caused them to move. but you've essentially then got a sympathy play like I mentioned earlier, but also one that is expecting the same or similar results. So these biotech plays can be perfect for this most of the time because they are so volatile and can have such big moves, and it seems like there are always catalysts around every corner for these types of stocks. Another thing to remember here is that we're trying to buy options that are close to expiration. Now, this could mean that they expire within that week. You're pretty much looking at the closest expiring options at the time. Now, these are plays that were basically taken in order to take advantage of the current volatility, which will drive an option price up, and also the momentum. So we're not looking for long-term plays. We're not looking to buy options that we are going to intend to exercise. And we don't care about anything that happens with the company. We don't care if the catalyst turns out to be, something big. We don't care about anything else other than being able to capitalize on the current move, the move that we're seeing right now, that day. So essentially, we're looking for options that are about to expire and are dirt cheap, out of the money options. And 99% of the time, this is just a day trade for us, except in those certain situations, like in my situation where I showed you that I sold 4 options and kept 1. In a situation like that, it's okay to keep an option past that day. But, your numbers are going to be different than mine. It all depends on your risk tolerance, and all depends on, your perception of that stock and what it's going to do. Everybody is going to be a little different, but the main thing that I want to keep constant in this, and what I want you to understand, is you're going to take risk off the table ASAP. That's going to be the first thing you're going to do. So I don't care, what you're trading. I don't care how good of news you are expecting. You're going to take that risk off the table first thing. That's what you're going to do. That's what's going to keep you alive in this game. That's what's going to allow you to survive and be able to live on to trade another day. That is the most important thing. I want you to understand that. After that, you can worry about your profits and how much profits, or how much profits you're going to take, what you're going to leave on the table, and risk losing. I don't care about any of that. My main focus is to make sure that you don't lose money while you're learning this. Outside of that, I don't care. It's up to you. But make sure you take the risk off the table first thing ASAP. If you've traded options before, then I'm sure you're already aware that an option does not have to be in the money in order to increase in value, meaning you can profit from buying a call option without the price of the shares reaching the strike price of your call. In fact, as the stock price increases, the call option should increase, or the value of the call option should increase. So take risk off the table ASAP. And what I want you to focus on, and especially if you're new to options trading, is to take the risk off the table immediately, which means as soon as you are able to sell either one call, or even if it's more than one call, if you're purchasing more than one, as soon as you're able to sell some to get the risk off the table, meaning to pay yourself back for the amount of the original investment, do that. Even if it leaves you with, only 1 or 2 call options that you're getting for free after that point, do it while you're learning, because this is, something that's tough to learn, something that's tough to, really grasp unless you've done it quite often. So do yourself that favor, take risk off the table, and then once you've, become good and familiar with trading options, then you can do crazier things or kind of, relax a little bit with your options trading. But while you're trading under my roof and my rules, this is how I want you to play it. So I guess there's only one thing left to do now, and that's for me to show you how to actually purchase an option on Robinhood, which is fairly simple, but I did promise you guys that, and even though this video is getting awfully long, I'm gonna go ahead and do that real fast. So the stocks that do not have options available are not gonna have the trade options button. They're gonna either say buy or sell. This one obviously does. Now, let's wait for this to load up. It may not because this is slow. But either way, here's your dates. So these are the options that are expiring on December the 18th. Then you've got your options expiring January 15th, 2021. Then you've got your options expiring April 16th, 2021, and so on. Now, these dates are going to be different for every single stock. Some stocks have weekly options that you can trade. Some stocks, only do it monthly. It's different for every stock. You just have to open it up and see what it has. But how you would buy an option. So right here, we're looking at, a $7.5 call. And let's say we click on it. It'll show you, contracts times 100 shares because each contract controls 100 shares. So if I put 1 in there, it'll tell you limit price. So this is where you would actually put in your limit price. We see that the bid is 25 cents and the ask is 30. This being Robinhood, it's going to be kind of tough to get filled. If you want to get filled immediately, you're going to put in that ask price, and sometimes not even that works. But, let's say we want to alter or edit. We're going to put in 0.3, and that'll put us at the ask. So as you see, the max cost on that is $30. So then I would just press review, and it tells me I don't have enough buying power. And right now I don't have enough buying power because I've got some options that are settling. As you can see, the max cost here is $30. I'm going to encourage you to always use a limit price, especially on Robinhood, because if you don't, you can end up paying a lot more than you're intending to, okay? Now, let me show you one other trick here. Okay, where it says limit price and bid is 25 cents, ask is 30 cents, that little down arrow, click on it. As you can see, you get a lot more information here, okay? You get the mark, which is basically the mid price between the bid and the ask. The high has been 69 cents on this, which means $69. The low, 3 cents, which means $3. That's for the last trading day. Now, the volume, 4,028. Open interest, 12. Now, you remember the volume and open interest on on my personal contract that I showed you guys. It was way different than this, was it not? And as you guys can see, this is something that's more realistic, except for the volume here. Normally you don't see volume or high volume like this on a lot of options where you're trying to buy expiring contracts that are out of the money. The implied volatility here, it's 261.96%. Now, normally you would want to look at the historic volatility or historic IV for a specific stock if you want to know whether it's high or low. But I can tell you right now, without looking at the historical IV, that this is high for this stock. And the break-even price right here, $7.78. Chance of profit, 13.95%. So pretty low percentage here. You've got your Greeks, your delta, theta, rho, gamma, vega. Now, I'm not going to go over all the Greeks here. We just don't have time in this video. I should have ended it a long time ago. But I will say this, pay attention to your theta because that's your time decay. So for this specific contract, the 0.04, that means you're losing $4 per day, assuming that this option doesn't, move. By the way, at the very top, you've got buy and sell. So whether you're buying an option or selling an option, that's all you got to do is tap on one of those and choose your date. Of course, I said we're going to choose the closest expiring date, which would be December 18 for us for this particular strategy. Now, keep in mind, the closer we are to expiration, the more value your option will lose every single day, because that's extrinsic value. Congrats, ladies and gentlemen, you've made it to the end of the video. If you like what you watched, make sure you subscribe, because I put out videos just like this one every single day. And please do me a favor and smash that like button if I helped you in any way, because it really goes a long way in helping the channel out and keeps me motivated to make videos every single day. Now, there's a lot of work involved, a lot of research, and a lot of time and effort into editing and putting these out daily for you guys. You can subscribe from your screen right now, or if you want to watch one of my other videos, I'm sure YouTube has some good content picked out for you on the left-hand side of your screen now. Thanks for sticking it out with me till the end, and I will see you guys in the next video.